Welcome on in today. You are watching Lowcountry Money Talk, and guess what? We're talking money. It's an important topic. We're talking about retirement. I am joined now by Phil Bloyd. He's with Revolutionary Financial Group, and it is a pleasure to see you again.
I'm glad to be here, Jessa.
We got a lot to talk about, Phil. This is a big episode. We're going to talk about the 2 phases of retirement, and I understand you think it's important to really talk about it in these 2 distinct phases. Tell us exactly what you mean.
Well, we have the accumulation phase. So this is as you're preparing for retirement, pre-retirement. Hopefully it starts really early for you. You know, when you start working, you have a job, you're adding to your 401k paycheck to paycheck. And then we have the distribution phase. And that's where it's really important, where you're retired, you've accumulated all these funds, and now it's time to start taking them out to supplement your income and such.
Okay, so as we are working our way through these 2 phases of retirement, let's talk a little bit about some differences in, how you might act during these phases. But I think more importantly for today's topic, how do you plan well? And of course, that's where you come in for these phases of retirement.
The market has been extremely volatile, over the last month or so, maybe even longer. So it's very important that you have a plan. So let's talk about the accumulation phase first.
Okay.
So we're younger, we're working, we have a 401k, maybe we're self-employed, and we have a retirement plan that we're making our own contributions to. So we have money going in every pay period, whether it's every week, every 2 weeks, or whatever. So in the accumulation phase, we have the good luck to have the money's dollar cost averaged in for us.
Okay.
So we're buying in either weekly, every 2 weeks. So along the way, the market's doing these kind of things here. So I have some funds going in when it's down, I have some funds going in when it's up. And of course, based upon my age, as I'm younger, I may be a little more aggressive in the stock market. I'm looking at a longer time horizon before I need the funds. So it works to our benefit. I would recommend, that we look at how the funds are going to be taxed. If you have the opportunity at work to have a Roth 401k, I would prefer that to a traditional 401k, just because in a Roth 401k, you don't get to a deferral on the taxes and all that stuff. You kind of pay them as they go along. Mm-hmm. But as you accumulate this big chunk of wealth, at the end of the road, once we start the distribution, we don't have to pay taxes on that growth.
Right, and obviously that's part of what you're really helping people to plan for is, not only where does the money need to go, but what happens to it in those different buckets, and at what point do we need to start thinking about those things. I want to talk a little bit about stocks after retirement too, and whether or not, obviously a lot of folks watching the stock market very closely right now as things change, but is it a bad idea for people to own stocks after retirement?
No, because longevity, people are living longer now. If we go back to grandpa, grandma in their retirement, maybe granddad worked until he was 65 at a factory. Probably grandma didn't work. She may have, but probably not. And then at 65, grandpa retired. Maybe start drawing a defined benefit pension, which we don't see a lot of those anymore, where he was getting a certain amount a month, and then he was getting a Social Security check, and then grandpa probably didn't live too long.
Right. Now
grandpa is living to be 79 or into the 80s, but also grandpa retired maybe at 55. So we want to make sure we have a good amount invested. I like the rule of 7, or the rule of 100. Okay, we'll talk about the rule of 72 later. But the rule of 100, we take our age, we subtract it from 100, and I like that, the difference in equities. So let's say grandpa's 70, and then we're 30% in equities. So we have stocks, ETFs, mutual funds, whatever we may be into. But with 30%, and these funds will be used for the longevity of retirement. But because we're not working any longer, we have to be careful because we don't have that dollar cost averaging going. So, maybe we can talk a little bit more about that in the next segment.
I think that'd be good because I know I have more questions. I'm sure our viewers have more questions, and there's a lot of math here, Phil. So that's where having the expert on hand is very helpful. We're going to get back to that more on the other side of this break. This is Lowcountry Money Talk. We'll be right back. Welcome back in. This is Lowcountry Money Talk, and lucky for you, the expert is here with us today. We are talking about retirement, the 2 phases of retirement, as Phil Bloyd likes to see it. And he, of course, is with Revolutionary Financial Group. Lowcountry Money Talk, covering all kinds of good financial information you're going to want to know. Thank you for being here.
All right.
So we covered a lot before the break.
Sure.
And we have a lot more to cover. We're talking, of course, about the different phases of retirement, and you've talked a little bit about it. I want to spend a little more time on that distribution phase and what we might do to plan for that.
Absolutely. So we'll look back a little bit about retirement years ago and compare to now, what people face. So years ago, we were talking earlier about, grandpa, grandma, and maybe they worked for one company. And they worked for that company their whole lives, and they retired, they got a watch, they got a pension, and they're gonna supplement their income with Social Security, but they didn't have much invested maybe in the stock market. Things were different. A lot of people didn't invest in those days, they just went to work. Now people work about 7 different jobs in their lifetime, at least. I would say now, maybe even more.
I know, I'm counting in my brain how many I've had now. Yes.
Yeah. So how many 401ks, right? So, sometimes people will leave employment and they leave the 401k and they don't pay much attention to it. Well, it needs to have some attention paid to it. Sometimes they'll roll it over into an IRA. And then maybe these days it's a little easier to do your own trading, so they might go in and they might buy some equities or some index funds or some ETFs, who knows. But back with grandma and grandpa, they didn't really do that much. Mm-hmm. So now people pay hopefully a little more attention to things, but also those old pensions like grandma and grandpa used to get,
yes,
they're phasing out really quick unless you work for a government entity or a school. So now people are having to save for their own retirement and their 401k. And a lot of people, some people are good at investing and some people it's not their cup of tea.
Absolutely. Yeah, and it is interesting. All these differences really add up on you too, because you're talking about, previously maybe having a pension to go on, mm-hmm. And then also maybe even retiring a little bit later, but certainly the life expectancy, as you mentioned in the break, prior to the break, obviously is a big factor as well. Sure. We're expecting to live longer, right. So we need more money now, and we have oftentimes less available to us unless we're good planners. So talk to us a little bit about that. How is it that you are able to, really help set people up for success and make sure people can get in touch with you and help navigate some of this
Sure.
stuff?
So now let's talk about, we've saved up all this money. We're getting ready for distributions. So some people are still investing like they were 30 years old,
right,
but they're 60.
Absolutely.
Or 70. That scares me a little bit.
Right.
The market volatility has been extreme, mm-hmm. in the last several weeks. So that gives us a little, cause for thought. So the important part is we still want to have the right amount in equities, because the Standard & Poor's 500 index averages about 10% over the last, say, 100 years or so. So if we have a lot of money that's in a lower performing area but safe, we have to be careful, mm-hmm. because we need that return over time. But a stock market wipeout at age 70 is really not a very good thing. So we have to be careful. We need to analyze, make sure we have the right amounts at risk, mm-hmm. the right amounts at a lower risk, so that doesn't happen, because we've already accumulated most of our wealth by the time we retire.
Right, and these are huge considerations for people who are currently now retired already and making sure they're in the right spot. So to your point, they're not eliminating or wiping clean some of the things that they've accumulated over the years. But also for people who are entering retirement, you know, they really need to start planning differently. And so there's a lot to consider. Thankfully, we're going to cover some of that as we navigate the next couple segments here. We're going to talk about one of the biggest fears people have in retirement, which is outliving the assets that you have and some of the ways that can really ruin your retirement.
Sure.
So we'll touch on that in the coming segments. Thanks,
Sounds
Phil.
good.
Thank you for watching. This is Lowcountry Money Talk. We have more after this. Welcome back in. If you're just tuning in to Lowcountry Money Talk, we have had a great discussion about retirement and some things you're going to need to know. As Phil Bloyd puts it, there are 2 phases to retirement. We've got Phil here, of course, with Revolutionary Financial Group. We are talking a lot about a big topic. Thanks for being here.
Oh, yes.
So, before the break, we talked a little bit about one of the biggest fears people have in retirement, which, of course, is the fear of outliving the assets that you have saved. And boy, how that can ruin your retirement and really the enjoyment of it. So we're going to touch a little bit about how, you know, of course, running out of money is possibly one of people's biggest fears.
Right.
How do you help your clients deal with this concern?
Jessa, it's a major concern for people. When I look at retirees coming to me, though, many times bring their account in and say, hey, I want to make sure that we have enough to live in the retirement. So the first thing we might do is we may do an income plan and say, okay, we'll look at different projections and how you're invested and make sure that we don't see what we call the red. Now, on the other hand, I've been doing this for 30 years. So I have also some depression babies, and they may be 95 years old and have all kinds of money saved, and they're still worried about running out of money.
Yeah.
So
Right.
I'm like, well, I'm not trying to be nasty, but we may run out of time before we run out of money.
Right, right.
But with most people, the thing we have to realize with an income strategy, we need to have an income strategy that applies to what we will call a bull market, which we're currently in, where the stock market's doing real well, you know, minus the last few weeks there, and then a bear market, when the stock market sells off at least 20% of its high, we would consider that to be a bear market. So the income needs to change a little bit based upon what market we're in. We've always been told, sell your equities or your stock accounts or your growth funds when they're high, right? Although most people, they get scared and they sell low.
Right.
But we've been told sell high. So when we're in a nice bear market, we may want to take some profits from those equities to provide our income. But as that changes, and let's say, for instance, we enter a bear market, we definitely don't want to be selling any of our equity positions because they're at a lower value.
And you know what's difficult about that, of course, is the emotional aspect of it. So it does take, oftentimes, you know, I'm sure you often become sort of a therapist for people in times of difficult markets, because it is scary and uncertain, and that is what you tend to do, is sort of withdraw. So let's talk a little bit more about like the idea, the concept of income uncertainty and how it's impacting those who are retired. You know, there's a lot, of course, tied to the stock market and differences there, but there's other factors as well.
Sure. Well, we could have health problems. We need to take out a bigger amount of money. But let's go on the income side. You know, as you mentioned, sometimes I have to stop people from, you know, getting on the ledge and about to jump over, you know, the side of the railing. But if we have a plan, it kind of takes some of that fear away, because of, oh yes, I remember, you know, we were in a meeting, we talked about the bear market and where the income was going to come from, and we want it flexible enough so that we can interchange the two. So let's say a bear market, if we go back to March of last year, Jessa, wow, we hit a bear market in like 30 days or less. So, you know, it can happen very quickly. So we need the flexibility in our plan that we can shift from a bull market income to a bear market income, because we want to preserve our equities, because over time we know if we want that historical rate of return on the equities, which we mentioned the S&P 500 at 10%, that it has to be over long periods of time.
Okay. Well, we got more to talk about on that topic, and really talking about the best way to deal with income uncertainty if you are in this position. So we'll have more of Phil Bloyd after the break. Thanks again for being here. Thank you for watching. Stick with us. We have more Lowcountry Money Talk. If this sounds like you, worried about running out of money in retirement, you are not alone, and today we are addressing that problem. If you're just tuning in, you're watching Lowcountry Money Talk. Phil Bloyd is here with Revolutionary Financial Group, and we're talking about that retirement, the fear of running out of money during retirement, and we're going to learn a little bit about the best way to really deal with income uncertainty. Help us out, Phil.
Okay, so the best way to deal with income uncertainty would be to develop a written plan. If we can have a written plan, then we can monitor the plan. And if when people first retire, Jessa, believe it or not, they don't really know exactly what their income's going to look like, even though they think they do.
Yeah.
So in the first few years, I like to keep quarterly meetings or so, or let's keep things flexible where we can interchange, because over the first 2 years the retirees are really kind of figuring out their foundation for income over that time period, because they're moving from where they worked, and maybe lunch and visit and money here and there and buying this or that, and then they retire and things kind of change a bit.
Right.
So it's good to be a little flexible in the first few years, but we can still have that written plan, and then we can kind of monitor the plan. Now, what many clients do, we'll sit down and develop that plan together, and then they like to just go live they're like, Phil, okay, I just want to live my life. I want to enjoy retirement. We did the plan. This is your headache, you deal with.
Right.
And it's like, okay, some of them will call to touch base, and not necessarily, the market may be in a bad day. And they're like, boy, I bet you're pulling your hair out today. And I'm like, hey, I've been through this a few times over 30 years. So the best thing is to have that plan. So have it in writing. We can monitor it. We can change it. I do believe we're going to have some very different market years ahead of us. If you just saw what happened after Thanksgiving, it was Black Friday on the market. We should call it Red Friday.
It was Red Friday. Oh, I'm telling you.
Didn't make your shopping too easy then.
No. And that's where you come in though, Phil, because to your point, people call in a panic. Mm-hmm. You've seen the ups and downs. You know how to handle it, and you know how to talk your customers through it. And another big thing on people's minds, of course, is it depends on how risky they are in their assets. And obviously the more risk, the more reward, but also the more difficult they can be in difficult times. So how do you help retirees really deal with that, manage that?
Sure.
Assure that they have the right mix of, the higher risk pieces and the lower, maybe more safer pieces.
Sure. Well, the first thing we do is, and this will be for everybody that's watching, all of our viewers out there, when a person comes in, we ask, bring your current statements, let's take a look, let's do a risk analysis, and let's make sure what you're telling me matches with what I'm looking at, because many times it does not.
Isn't that something? And I know you've got lots of examples. We won't maybe share any today, but it happens all the time, doesn't it?
Well, what I say many times, I'm like, wow, you look a little aged for someone that's 35 years old, because that's the risk portfolio I'm looking at, is a 35-year-old, but I may have a 60, 65-year-old, although they still look very well, not a 35-year-old.
Right.
And I'm like, then we talk about how did we get to this position, where do we need to be, and how do we make that transition.
Right. Okay.
So all the viewers can contact us. You have our information all over the place. Give us a call. Rachel is the one typically that you would be reaching out to, and we would have you come in and take a look at do an analysis and see how you're matching up.
Yeah, absolutely. Well, all really good points, and it takes the help of an expert like you who has been in the business for as long as you have, decades now, and really understanding what to look for, what is needed at different stages of retirement and different ages, and really how to best manage finance and enjoy retirement. So
Yes.
thank you for some of these pointers today.
All
Phil
right.
Bloyd, again with Revolutionary Financial Group.
right.
What a
Have
fun
a
show.
great day.
Lowcountry
Enjoy.
Money Talk. We'll see you next time.